Well, a sizzling September jobs report dropped on Friday, sparking a renewed rally on Wall Street as equities notched fresh record highs, while also we saw substantial demand for the dollar, which rallied against most G10 peers as treasuries stumped and the curve continued to bear flatten. A quieter calendar awaits this week with US CPI, the highlight of a more empty data docket, though geopolitical events, of course, remain in focus, and we also move towards the start of third quarter earnings season. Plenty to discuss on the trade-off this week. Without further ado, let's get on with the show. So plenty going on in markets last week, and joining me to try and make sense of it all, as always, my good friend Ryan Littlestone from Forex Flow Live and Forex Analytics. And it's a very happy Ryan Littlestone on this Monday afternoon because his team beat some minnows at the weekend in the football.
Yes, they did. We finally managed to see a win at home. So yeah, I'm taking it while I can, while we saw some goals, and enjoying it until the next defeat rolls around the corner.
Well, I mean, there's an international break, so you'll have to wait a fortnight for that. But being a West Ham fan, I suppose you're used to disappointment at this stage.
Oh, here we go. A bit early to start getting all that out, isn't it? Put it this way, at least we're not Spurs supporters, eh?
Oh, yeah, that's true. I must admit, I've been feeling a bit under the weather over the weekend, and Spurs football on Sunday afternoon really did cheer me up, actually, them throwing away that 2-0 lead. Anyway, we can't sit here and talk about football all day. We do need to talk about the markets as well. So let's get into topical. Right, so let's start with Friday's non-farm payrolls print and the US labour market report. And, well, first things first, Ryan, I've got a question for you. Where did I come in the Forex Analytics sweepstake this month?
Where did you come? Officially fourth. But, as I said to you, just because you're standing on top of this doesn't mean you're that much closer to the sun than I was. But, yes, well done, Michael. For once, you actually got within a reasonable stone's throw of the number.
Thank you, mate. It was, more by luck than judgment, I think everyone would agree. But nonetheless, I was relatively close to that 254,000 jobs that we saw added to the US economy in September. And it was, of course, a very, very strong September labour market report, not only in terms of that headline metric, but also when you dig into the details of the print as well. We had a net 72,000 upward revision to the prior couple of months worth of data. Unemployment came down to 4.1 for a prior 4.2%, while, of course, participation remained unchanged, just shy of cycle highs at 62.7%. And earnings were a little bit hotter than expected, but still in check, rising by 0.4% on the month, equaling the pace that we saw in August, and by 4% on the year, just 2 ticks quicker than the pace that we saw in August. So I think it's quite difficult, to be honest with you, to complain about anything that we saw in that jobs report, either the data itself or how close I got to the actual number with my guess. But I suppose it does kind of beg the question as to why the Fed thought that they needed to start the easing cycle on the 18th of September. Around 3 weeks ago with that jumbo 50 basis point cut. But I suppose that is in the rearview mirror, and looking ahead, you would say that the jobs report reinforces the idea that we return to a more normal 25 basis points per meeting of easing from November onwards. Although it is worth bearing in mind that the market seems to have run completely to the other hawkish extreme now, with the OAS curve actually pricing just 21 basis points of cuts for September and less than 50 basis points of cuts for the year as a whole. And obviously, we've seen treasuries selling off across the curve as a result. But I think the biggest macro takeaway from the jobs data for me is that the soft landing is still on track.
Very much so. What a gangbusters report that was. I mean, no one was really expecting that one. I looked through all the bank calls for that day, and they were all wrong by quite a significant margin. So it's been part of the course. I mean, we saw some sort of evidence along those lines with the JOLTS reports. That was sliding down into the 7 millions, and we got a big couple of bounces there. Other reports where you might think, oh, here we go, there's a bit of weakness, and then it turns around. And this jobs data has done exactly that. Now, I know a lot of people are putting this apart in terms of, the type of jobs and will it get revised down and who's getting counted and all that sort of thing. But it doesn't matter. The numbers are the numbers. And we moved down to 4.1%. That gives the Fed a little bit more wiggle room for their 4.4% forecast for this year and next year. Wages, that surprise to the upside. You would have thought maybe they would have stayed unchanged, but they went up again back to 4%, where they've been glued to for quite many months. And it all plays into the Fed's hands of why did they cut a 50 when they've got all this good economic data coming through. As we've been saying, that seems to be more and more like a bit of an insurance cut. We need to go one while the jobs market is softening and while other areas are softening as well, just to build in a bit of resilience there. And we're almost on the other side of the coin now, where one good data point doesn't mean it's all going to be good. We have been seeing a slowdown coming. We have been seeing weakness in some areas, some sectors. The ISMs weren't exactly great reading a couple of days before. So we haven't got the whole economy moving in one direction, but we're getting these little speed humps, should we say, these little boosters. And like you say, it turns everything around in the market.
Yeah, indeed. And actually, I'm glad you picked up on the whole revisions thing, because there are certain people out there, they know who they are, who are, if the data is poor because it fits their narrative and fear sells and all the rest of it, then they will just take it at face value and run away with it. If the data's good, then all of a sudden the data's unreliable. You can't have it both ways. And even if the data is unreliable, and even if the survey response rate has fallen, and even if the data is going to be revised, one, it's the best we're going to get, and it's certainly better than any random number that you or I or anyone else is going to come up with. And two, that is the data that moves the market, whether you like it or not. And any market participant just has to respect the fact that although, non-farm payrolls, 254,000 in September, when we've had the two revisions, and by the time we get to December, the number will not be 254,000. But that's how it's been pretty much since the non-farm payrolls number has ever been produced. That is just how this works. The fact that the data is being revised does not mean that the BLS or some sort of political underling somewhere is trying to rig the data for one reason or another, or move the market in one way or another. That's not what's happening here.
Well, that's a rant and a half. I'm going to remind you of that next time I talk about ADP and Chinese data.
Oh,
when you're saying that the data is what the data is. But no, you're absolutely right, and you can take it up with all those who like to make those calls. As usual, we had all the banks right after that data scrubbing out 50 pip cuts and the like, and jumping to 25. So they're as bad as all the rest of them. But this is the trade-off, not the trade rant. So
yes, it is indeed the trade-off, not the trade rant. Although I think we do need a sort of topical rant section or something like that. In any case, although the Fed are squarely focused on the labour market at the moment, we do have some inflation figures out this week, and that side of the Fed's dual mandate has perhaps gone a little bit under the radar recently.
Yeah, it has, because inflation's been going their way, and given how we've got this key data that seemingly keeps beating to the upside, it wouldn't be a surprise to me if US inflation did the same. We're expecting the headline CPI number to drop 2 points to 2.3% year on year, and the core to come in still sticky, unchanged at 3.2%. Now, in this CPI data, we get all the propeller heads picking out the numbers, and shelter costs is one that dominates the services inflation side of things. And after coming lower for recent months, it rose for the second month running, went up 0.5% on the month, and that's the fastest rate since the start of the year. Owner equivalent rent, which again is another big CPI component, also rose 0.5%. Now, these were measures that some Fed members have been cheering that had been coming lower, and they've been turning right around again. So while those key components will be closely watched for any further upside moves, some other components are likely to see a drop. Gasoline, for example, saw over a 16% drop from September 2023 last month. So that's going to be a big chunk coming into the negative side of CPI. And it's much like other countries. We've got a lot of movement in the CPI basket both ways, and it's just really a question of whether price weakness or strength shows through in any one particular report. So for trading this data, while the market sort of may stay on the dovish side, the closer CPI gets down to the Fed's 2% target, the Fed will still want to see that core number coming down there too. And yes, talking about data again, we all know the PCE data is the Fed's preferred measure, but this data comes before that. And so the markets, again, are going to move for it, and they're going to look at inflation for September, and it's going to move on this number. Now, if we see some really hot data, again, expect the market to keep shifting to this more undovish, hawkish slant that it's got at the moment. And
hang on. Undovish? Is that not just hawkish?
No, see, I hate that. See now you've got me ranting. You see,
oh God,
I hate
Let
it
me make myself a cup of tea.
If it's not dovish, it must be hawkish, and if it's not hawkish, it must be dovish. There's no middle ground. You don't have to be hawkish just to say we're not going to, cut rates anymore. That's not hawkish. That's just undovish. So it's my word. I'm patenting it. It's copyright. So yes, it's not hawkish yet. We're undovish. So anyway, now you've put me in the red mode and right off my stride. So yes, the market will shift more undovish as it is now if we do get hot numbers. As we record this, I keep an eye on the CME Fed Watch. We've completely priced out a 50 pip cut for November. We're pricing a 96.6% chance of a 25 and a 3.4% chance of rates going unchanged. So another couple of hot CPI months, and we'll probably be pricing in hikes, no doubt, much to Dickie Matthews' joy.
Well, I was going to say it only took him about an hour after the non-farm payrolls number dropped on Friday for Dick to send me a WhatsApp saying, "Is it time for a rate hike?" Yes, if anyone can get an Oxford dictionary down to Bournemouth quickly for Ryan in time for next week's episode, that would be much appreciated, or an interpreter, one or the other, so we can understand him. But I do think that, in all seriousness, the CPI data is going to be interesting because we're actually seeing this kind of headline core divergence, not just in the United States. I think you're going to come onto this later on, but pretty much everywhere. It is energy prices that are largely dragging headline inflation lower, and those underlying price metrics are still quite stubborn and quite elevated. I don't think the Fed would ideally be too comfortable with core CPI running north of 3%, particularly when they've just delivered a 50 basis point cut. So it is going to be data that's very, very closely watched, but I don't think it's going to impact the policy outlook too significantly.
No, only if the market gets too extreme, as I say. If it's really hot data, core headline going up above expectations, core maybe going up to 3.3%, then we're going to see yields continue to rally, I think.
Indeed, yes. And I know you want to look at treasuries a little bit later on. In terms of policy more broadly, though, I touched on the idea of this global policy put in last week's trade-off, and the fact that everyone seems to be rushing to get rates lower in relatively rapid fashion. And we had more along those lines last week. We had inflation figures out of the Eurozone, with headline CPI rising by 1.8% on an annual basis in September. That's below the ECB's target for the first time in over 3 years, and the slowest annual rate of inflation since April of 2021. So the market now pretty much fully pricing in a 25 basis point cut from the ECB in October. That's certainly my base case. We heard from Villeroy over at the French Central Bank early in this morning's session, talking about how that is a likely move. Although the folks over at ING did have an interesting note out this morning as to why the ECB may not cut in October. But I think given the probability that the market assigns to such a move, it would be quite remarkable if the ECB didn't follow suit and to duly deliver that 25 basis point cut that we are now all expecting. Elsewhere last week, we heard from Bank of England Governor Andrew Bailey. He decided, for whatever reason, to give an interview to the Guardian newspaper, where he was saying that there is a chance that the bank become a little bit more aggressive and a little bit more activist in terms of rate cuts if news on inflation continues to be good. At one point last week, the market was fully pricing 25 bip cuts in November and December, although we have seen those dovish bets pair a little bit since the payrolls data that we had out on Friday. We also heard from the new Japanese Prime Minister Ishiba last week. It seems like he's been taking notes from Erdogan in Turkey and Lula in Brazil, saying that they are not now in an environment to raise rates. Not sure what BOJ Governor Ueda would say about that, but the yen nonetheless having its worst week in almost 2 decades last week, with the OAS curve now pricing just 7 basis points worth of tightening by the end of the year. And another stat that I saw last week, this from Bank of America, is that there were 26 rate cuts across central banks globally, EM, DM, and Frontier in the month of September, which marks the fourth biggest month of monetary stimulus since 2000. Now, I don't know about you, but that is not an environment that I would want to be short risking.
No, absolutely. But this goes to the larger point I've been making quite recently, and that you've got to have this at the back of your mind. All these central banks want rates lower. Okay, running rates at 4.5%, 5% is not good for economies in this type of environment that we are in this global environment as we are. So they all want rates down, even if we get good data, even with those rate cuts from the Fed, even with that NFP data. That's not going to change their mind. Yes, it may mean they slow how they cut rates, but it doesn't mean we're not going to get further rate cuts. So a lot of people who have been pricing out 25 pips now for November for the Fed, probably getting on the wrong side. They will continue to cut. That's what all central banks want to do. And I think you're right. We're in that situation now where you've got to keep that in your back of your mind when trading. Okay, you get a good data point, fine, go with it, trade it in that moment, but just remember what it means for that central bank. Is it going to mean they aren't going to cut rates? We've still got other central banks who are still lagging behind, as I'm going to talk about in a bit. But keep that theme at the back of your mind when trading, because that's where the market will revert to after every data point.
Indeed, you're absolutely right. In any case, why don't you move on to talk about those other central banks?
Yeah, and it's sort of talking about inflation and these central banks and whether they're actually going to be wrong again with their thinking and their calls. And again, I've been mentioning recently that one of my big risks going into 2025 will be inflation undershooting a lot of these central bank targets. As you said, Michael, Eurozone inflation, 1.8%. That's now 2 points below target. And although they moved their mandate goalposts from close to but below 2% to targeting 2% over the medium term, that in itself is a constantly rolling time frame. It seems like some of the EC members are actually starting to take note of that risk of undershooting. As you mentioned, Vilroy said about the October cut. He said one of the reasons for an October cut is due to the rising risk of inflation undershooting their 2% target. And the big problem that countries have now, where they face low or flat growth, is that they have a risk of inflation falling further and faster and picking up speed as demand and activity drops. And the first thing that causes price cuts is dropping activity, because then firms want to try and entice prices. So in many cases, there's a fine line between falling inflation and inflation turning actually negative, potentially also year on year. Now, given how central banks have as much control over inflation as they do smoke in the wind, the main risk building now is that they actually face a deflationary period where rate cuts become more stimulus-based or stimulus measures rather than high inflation controlling measures. But for now, they still believe that they can get rates down to a neutral level. But given the current economic trajectory in a lot of economies, it won't be long before markets start sensing they'll have to go lower, and that's particularly viable for the Eurozone and the ECB.
Yeah, it's not rare that this happens on the trade-off, but I think you might be the pessimistic one this week. I mean, all this doom and gloom. I mean, the data's not that bad. I agree there are certain places where you are perhaps running the risk of undershooting the inflation target. And in many ways, I would say that actually the big worry among G10 economies on that front will probably be Switzerland. Inflation at 1%, CPI in Switzerland, rates at 1%. They don't have particularly much room to take things lower if they were looking to provide some further stimulus to the economy. I think the big problem on the deflation front remains China. And of course, China returns for its Golden Week holiday, Tuesday morning, so they will have made it back by the time you watch this recording. It is something worth considering, but I think central banks' first priority is to get things back to neutral, and then in an ideal world they would keep things at neutral for some time and only deliver further cuts into what you would say is sort of outright loose or easy territory if we did get data proving that inflation was on a path to sustainably undershoot that target. And I think at the moment, you're looking at Eurozone headline CPI at 1.8, CPI in the US at 2.3, you'd expect this week. Core inflation still remains pretty elevated, though. And I think while you see that divergence, the undershoot issue is less of a concern. If we're talking about core inflation at 2, then absolutely you're going to see some very, very worried expressions on the faces of G10 central bankers, I think.
I agree in part with that. I mean, yes, you call me pessimistic, but then your theory is based on the fact that central banks can actually get this inflation trade right. And as has been proved a couple of years ago, they can't. So I'm going to side with myself and my own thoughts on that one. And if they think they can control inflation, well, as I say, they can go and go forth and whistle, I think.
Well, we shall see. Only time will tell on that one. Right, in any case, let's move on to some charts. So I'm going to start off with cable this week. A little bit of a kind of stairs up, elevator down thing going on in the pound last week. Cable taking a bit of a battering on Thursday after those comments from Bank of England Governor Andrew Bailey seemed to nod towards a potentially more rapid pace of policy easing. In fact, the one-day decline that we saw on Thursday, well over 1%, that was actually the pound's worst day in about 18 months, going back to March of 2023. And then, of course, we had the solid US jobs report and the subsequent dollar demand coming into the market on Friday as well. So we have come all the way lower from the 134 or the mid 134 highs to test the 50-day moving average to the downside at 130.75. And that is now the key support that the bulls will be looking for price to hold. If we do break below, then perhaps we get another test of the 130 figure to the downside. It does appear that downside risks to the pound have begun to intensify a little bit in recent weeks. You've had a narrowing policy divergence on both sides. The Bank of England becoming seemingly more dovish. The Fed, by default, as a result of that payrolls print that we saw on Friday, becoming a little bit more hawkish, at least in terms of what the market is pricing now compared to what it was pricing around 1 week ago. So it looks like, once again, Andrew Bailey could have brought the pound's bull run to something of a premature end.
Yeah, he's been off that bus for a while. He usually, every time he speaks, the pound dumps a couple hundred pips. So, yeah, that hasn't happened for a while. But I think this is a lot of this is more on the dollar side. Obviously, those remarks by Bailey hit the pound, but it was really pushing in an open door after we've seen some of the data, and then Friday's NFP data. Obviously, if you look at some of the other pairs, euro sterling, for example, we're seeing a bit of pound weakness there, but nothing of the magnitude we're seeing here in cable. That just goes to show, how volatile a currency it can be at times. And 1 minute you're looking at possibly trading 135. Now we're looking at trading potentially 130, maybe even worse. So swings and roundabouts for this one. I've got some decent levels, 130.5 before we get to that 130 figure. There's some big fibs down there as well from the April and August rallies. So it's going to be an interesting test over the next few sessions to see if we get down there and turn around some of those rallies we've seen.
Yeah, it is indeed. The other thing that's worth bearing in mind is the market was very, very long of sterling when we were up in those 133s, 134s. So I think some of the new longs that had come into the market perhaps bailing out on the back of what Governor Bailey had to say. In any case, let's move on to the Treasury market. And I've just seen your notes. You're using that bloody word again.
Oh, which one now? Oh, blimey. Oh, I'm dovish. Oh, get over it, mate. Get over it. Anyway, I'm going to talk about some pendulum swinging again.
Do you want to wait until you've got a chart before you talk about it?
I'm going to start putting on my chart now. I'm going to have a chart. There we go. Okay, so if there's one thing that's guaranteed, it's, as I said earlier, the market likes to run from one extremity to another. As we've now seen that with the Fed pendulum swinging from uber dovish to undovish. Here we go. We're now likely to see it moving towards hawkish. See, I've covered all three scenarios for you, mate. One asset I always watch
this week, aren't you?
Yeah, just wait till I see what I have next week. One asset I watch closely, as always, is yields, and we're getting into some interesting levels. Last week, my play of the day was looking to buy dips in US bonds if we saw yields up around 375, maybe up to 390. Well, after the NFP data, we're now touching 4% in both 2s and 10s, who are in fact trading in 4% now, pretty much as that pendulum has swung again. Now, the good thing about trading is that we don't have to just jump into a trade just because a price level we targeted gets hit. I always will assess a price move on its merits at the time. And after that data on Friday, I didn't really want to jump into in front of the bond market right then. So particularly now we've had this really sort of undovish, hawkish swing. Now, if we get that hot CPI data on Thursday, I can see yields potentially moving even higher. So again, I'm not yet ready to step in front of the train. For now, the 4% level is really important, especially in 2 years. The big level here is really 4.12%. Any extreme move over that, say to 420, 425, will put this yield right in the Fed's expected 50 pip cuts for the rest of the year, which will be high if the Fed does continue to cut next year. I mean, these yields are pretty high and probably higher than the market really wants them. So I'm still expecting buyers to come in at these high yields, and particularly if they move higher after the CPI data, if it's hot. And I think that's when we maybe get the brakes put in on the dollar rally as well.
Yes, I would actually fully agree with what you said there. I think we saw, well, probably towards the beginning of September, how there was this big rush to lock in yield ahead of that first Fed rate cut. And now the market has returned to, well, on a yield basis, basically where we were in mid-August in both 2s and 10s. And I see very little reason why it won't be the same thing this time around. It's just kind of giving people a second chance to lock in that yield before the Fed really do get going and deliver a series of rate cuts. Of course, it was a 50 basis point move, but it's only one cut so far. So, yeah, I don't think it will be long until the bond bulls are ready to pounce once more, and we do see a bit of a retracement. Perhaps the curve begins to steepen again as a result, and as you rightly say, you would expect that poses a headwind to the dollar as well.
Yeah, absolutely. And I think, crunch time could be Thursday's numbers.
Indeed, yes, not too far away and not too long to wait either. Right, moving on, a little bit of an equity focus now. The S&P 500, first of all, the path of least resistance, continuing to lead to the upside, last week being a fourth straight weekly advance for the S&P, even though we had that chunky move lower on Tuesday as Iran launched missiles at Israel. And of course, the market continuing to wait for a potential Israeli response to that attack, which is perhaps dampening sentiment a little bit and leading to a shorter time horizon in terms of trades than we would perhaps typically see. But nonetheless, when you set that to one side, Friday's jobs report reinforced one of the three legs of my bull case, which is solid economic growth and a tight labour market. Of course, the forceful Fed put remains in place. And now we turn to focus on the third and final leg of that bull case, which is resilient and strongly growing corporate earnings. And of course, third quarter earnings season gets underway on Friday with JP Morgan and Wells Fargo set to report before the market open. And that's really now the main risk for market participants to navigate. Expectations are that we see a fifth consecutive quarter of earnings growth. And what is important to bear in mind is that during the third quarter, we saw a roughly 4% downward revision to consensus EPS estimates. That's considerably more than both the 5 and the 10-year average. And why that's important is because it gives ample room for firms to beat those expectations. Although, of course, guidance that accompanies earnings will also be key. But personally, I remain, it won't surprise you to know, bullish on the equity space more broadly, and some decent corporate earnings could be a nice tailwind for risk as well.
Yeah, I think this corporate earnings season is going to be a bit of a spicy one potentially. I mean, I can't remember if it was Goldman's or JP Morgan who said a few weeks ago that trading in Q3 was already down 10%. So there's potentially some wobbles to come. And if I recall correctly, some of the guidance that we got from some of these firms for the third quarter and the rest of the year wasn't that hot either. But like you say, they could just be setting a low bar to then go and beat it. They know the numbers themselves. So what does this one do? It's still, we have this conversation virtually every week. There's still no real reason why stocks should go down significantly unless something really breaks. But if we get some wobbly numbers, then we're likely to see a good dip, and if that's supported then by further good data, stocks are going to come roaring back again. So we're still in a buy the dip market.
Indeed. Yeah, just on that, I think it's a really good point. JPM or Goldman or whoever saying, trading is 10% lower. Great. That caused a knee-jerk move lower in the price when they announced it 6 weeks before earnings. When earnings come out and trading's 3% lower, everyone goes, oh, bloody hell, that's good, because it's 7% better than we expected, even though it's still lower than where it was previously. So, investor relations departments are very, very clever with the guidance that they issued before earnings. Anyway, Ryan, you want to look at the equity space as well.
Yep, I'm going to look at Spain, actually. I know you raised your eyebrows about this one earlier. So I'm taking us to sunnier climes this week, and maybe the possibility for some stock market divergence. We know, obviously, that stock markets usually don't reflect any semblance of reality, the case in point being the state of the German economy versus where the DAX is. But I'm wondering if maybe we start to see that change. Spain has been a bit of a shining light among the bigger Eurozone countries and is looking pretty smug versus Germany at the moment. In fact, it upped its growth forecast for the next 2 years and dropped that news twice right after releases of poor German data. I'm not saying they did it on purpose, but you can draw your own conclusion from that. We had 2 separate incidents of them upping growth right after we got that bad data. I think there's going to come a time whereby if countries like Germany continue to see economic weakness, we might see a bit of investor flight to where growth is best. And Spain is ticking all the right boxes at the moment. I think this is a trade to look at maybe going into the end of the year and certainly at the start of next year when you get a lot of funds who start positioning for the new year ahead. So if the market gets bearish over Europe as a whole, then Spanish equities might be a decent dip buy trade down to maybe the 10,300 area, the 10300 area. Conversely, if it breaks 12,000, 12,500, that might be a break trade to go with. So possibly some moves on either side of the coin here, but I think Spain may shine in 2025.
Well, we shall see. Only time will tell whether this rally becomes Juan for the ages or we see the market take a bit of a siesta and pull back. But I'm glad you brought it up nonetheless.
Hang on a minute. Where are they?
Has he got his red card? I love how you keep that handy now.
There you go. You can have a yellow for that one.
Oh, you can't find the red one. I've got away with it this week. I do think it's a good point, though, and I think certainly if we see the ECB beginning to ease at a more rapid pace, then you are likely to see some further support for the European equity space. And maybe you do see the southern European markets. The FTSE MIB is another one to keep an eye on, begin to outperform, given the well-documented woes that we see not just in Germany but also in France as well, of course.
Yeah, very much so. I think it's going to be an interesting end to the year.
It certainly is. Right. Well, hopefully it's an interesting end to the show as well with our plays of the day. May surprise you to learn I didn't think of those puns in advance either. They were purely off the cuff as you were speaking.
That just makes them worse, mate.
Oh dear. Right, well, let's look at our plays of the day. I'm looking at gold this week, and we literally just spoke about how the path of least resistance leads higher for stocks. For gold, it tends to be the opposite. And what I mean by that is the equity market doesn't necessarily need a reason to go up, but it does need a reason to sell off. Gold tends to need a reason to rally, and it doesn't tend to need a reason to move sideways or to come lower. And that's exactly what we've seen over the last week or so. And I do start to think that gold is looking on relatively shaky ground when you consider the amount of risk that is in the market and the fact that gold hasn't been able to reclaim those record highs around $2,685 an ounce. And you chuck into the mix the fact that the dollar is rallying pretty relentlessly, treasuries are selling off across the curve, and sentiment is still relatively firm with the equity market moving to the upside, particularly on Wall Street. It does feel like gold has become a bit exhausted and that there are quite a lot of headwinds now for the yellow metal to deal with. Now, given the relatively relentless run higher that we saw earlier in the year, I don't think I'd be looking to get short just yet. But if we were to get a break south of that 2,600 figure, then I would definitely be looking to play this from the short side. It just looks as if gold is getting a little bit heavy and a little bit exhausted at this moment in time. Ryan, you are going down under.
definitely going down under to find my red card that I've dropped under my desk at the moment. But from a trade perspective, this is a trade Aussie Kiwi. I've already started. I'm in at 110.40 for shorts, and I'm looking to fade a pretty dovish market expectation for Wednesday's RBNZ meeting. The market is expecting a 50 basis point cut, but based on the evidence and prior messages from the bank, I'm struggling to see why they would cut 50 basis points. However, when trading, it pays to be objective, and that can help you when knowing your risk and assigning your risk to any trade. So while I don't think they should go a 50, there's reasons why they might. The first being that their rate of 5.25% is quite high still versus the others, and they have been worrying about a weakening economy. On the flip side, they have said that they want to keep rate cuts slow. They want to keep reducing restrictiveness of rates rather than cutting so that it adds stimulus. So that's a reason why they won't go for a 50. Part of this trade, though, is playing short the Aussie dollar for a dovish turn later on from the RBA. So this is a trade I'm going to be looking to build and hold. Now, if the RBNZ go 50, I'm going to look to add up into the 111.50, 70 area. But obviously, I'll assess how dovish any 50 basis point cut is. Obviously, there's some scope for some quick profits if they do go 25 and disappoint the market expectations. So there's a bit of something for everyone in this one.
Indeed, yes. And of course, the RBNZ in the very small hours of Wednesday morning for our viewers in the UK. Right, well, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Toy Live and Forex Analytics for joining me. Thank you also to a very sleep-deprived Kyriakos for bringing things together as brilliantly as he always does. And thank you, of course, for watching. Hopefully you've enjoyed the show. If there's anything you'd like us to discuss on next week's episode, then please do drop a comment on the video. Also send Ryan a dictionary and a red card for use in next week's trade-off as well. And that is indeed when we'll be back with another episode of the show this time next week. In the meantime, have a very good week ahead. Thanks for watching and goodbye.